Good afternoon. This is Robert Karras of our Karras Asset Management and Planning in Independence, Ohio. I'm here today to discuss several aspects of financial planning. We have created a series of brief videos in an effort to help individuals understand the basics of financial planning and some of the pieces involved. Today's video is titled Investment Basics and is geared toward the selection of stocks as a piece of your overall asset management plan. There are many pieces involved, but today we're just going to focus on some stock selection. Many times people associate investing with speculating or gambling. This approach rarely works by trying to time the market. Others see investing as more of a long-term, methodical effort to save for the future. In fact, investing is a little bit of both. All investing, however, does involve a certain amount of risk, including the potential of loss of principal. Whenever investing, consider a carefully planned approach to manage and accumulate money. Investment planning requires discipline and patience. One of the items we utilize in the planning process is a risk tolerance questionnaire. This allows us to understand a client's level of comfort when it comes to risk. We all understand with investments you can't completely avoid risk, but you can, however, manage it. This risk factor we uncover helps in deciding which individual investments are right for you, the investor. Would it be an aggressive model, a more conservative model, or something in between, such as a moderate approach? One of the greatest investment fundamentals is the relationship between risk and return. We've assembled various investments and laddered them from safest to most risky. If someone may be very risk adverse, they should stick toward the bottom of our risk ladder. Of course, the extreme opposite would be options and futures. No one asset is right for everyone, but since there is a risk-return trade-off, we highly suggest your plan be matched for the level of risk you could assume. Listed here are several types of commonly held investments, ranging from the safer cash and cash alternatives to bonds, stocks, other investments, and the widely held mutual funds. Many people think of 401k plans and IRAs as an investment. These are not investments. They are tax-advantaged vehicles that hold individual investments. When you buy common stock, you're actually purchasing a share of ownership in that corporation. When you do purchase these shares, you become a stock or a shareholder. Your percentage of ownership also represents your share of risk taken and profits generated by that company. If your company does well, your share of total earnings will be proportionate to how much you own. The same is true on the flip side. If the company suffers, your share of loss will be greater. Stock ownership may also entitle shareholders to dividends and capital gain payments. Corporations may issue two types of stock, common and preferred. While these stockholders both buy stock with the intention of the stocks to rise, there are some differences. Common shareholders have the right to vote on company issues, while preferred holders do not. And another difference is common shareholders take second position behind preferred shareholders to claim earnings and assets of the company. In essence, preferred shareholders are given priority over holders of common stock when it comes to dividends and assets. Preferred shareholders typically receive a fixed dividend, usually on a quarterly basis, while common shareholders only receive dividends at the discretion of the board of directors. Generally speaking, common shareholders benefit more when the company does well, but may lose more when the company does poorly. Stock is commonly categorized by the market value of the company that issues the stock. For example, large cap stocks describe shares issued by the largest corporations, and some other general categories include small cap, mid cap, and micro cap. Stock is commonly classified according to the characteristics of the company and/or the expectation of investors. For example, Growth stocks are usually characterized by earnings that are increasing at a faster rate than the industry average or the overall market. These are often in new or fast-growing industries and frequently have the potential to give shareholders returns greater than those offered by the stock of companies in older, more established industries. Growth stocks are among the most volatile classes of stock, however, and have significant risk for loss. Value stocks are typically characterized by selling at a low multiple of a company's sales, earnings, or book value. Income stocks, on the other hand, generally offer higher dividend yields than the market averages and typically fall into the utility and financial sector, as well as other stable and well-established industries. Blue chip stocks are the stocks of large, well-known companies with good reputations and strong records of growth profits. They also generally pay dividends. Also worth noting are American Depository Receipts, or ADRs, which are negotiable instruments created to represent shares of stock and sometimes bonds in non-U.S. companies. The advantages and disadvantages of investing in stock depend largely upon the stock or type of stocks that you choose. In general, though, stocks offer a greater potential for returns than do bonds or cash alternatives. Historically speaking, this has been particularly true for long-term periods. With stocks, you actually own a share of the company and therefore have ownership rights, which may include voting rights. You can invest in stocks that has a history of paying regular dividends. You can also invest in stocks that have the potential to appreciate significantly in value. And stock is an easy way to buy and sell. Of course, if the company you invest in performs poorly, it may not pay dividends, even if you had regularly paid dividends in the past. More importantly, though, poor performance may result in your shares losing value. In fact, your shares can lose value simply because they're subject to the general volatility of the stock market, which has experienced sharp declines in the past. This volatility means that your risk of losing principal is greater with stocks than it is with bonds and cash alternatives. It also means that stocks may not be appropriate for short-term investment timelines unless you have a high tolerance for risk. I welcome the opportunity to meet with you and to address any specific questions that you may have based on the stock video we just saw. This is Robert Karras of R. Karras Asset Management and Planning in Independence, Ohio, and I thank you for your time.